So I got a question for the audience. A question mark here. Who can tell me what this is? Just shout it out. What is this? A lockbox, strong box, right? Okay. So I'm going to put that strong box right here. And a strong box has some unique principles or properties. It's impervious to heat, cold, fire, and water. In fact, I could put something in this lockbox and I could hit this lockbox with a hammer and it's going to be perfectly protected. I think you'd agree this is a pretty safe place. Now for a moment, I want you to think of all of the money that you have accumulated for retirement and it's inside this lockbox, okay? Now, these two books represent only some of the 75,000 pages that are in the Internal Revenue Code. There's nothing special about these pages. They're not impervious to heat, cold, fire, or water. In fact, they're just pages. I could take these pages and I could tear them up with my hand. But these pages have got a unique ability to get inside this lockbox and take out money that you've put aside for retirement. Now, over the next hour, we're going to talk about different ways that the IRS uses to take money out of your lockbox. And then we're going to examine some strategies that you can employ yourself to keep more of your money in the lockbox. Because tonight, we're going to talk about taxes and retirement. I want to welcome everyone here to Stonehill College. My name is Stephen Dellelo, and I'm your instructor for this first of a two-part informational workshop. This will be the first part. We'll have general information, and the second part will be when we meet individually for your particular situation. We're going to have an awful lot of material that we're going to be covering in the next hour, so you're going to be taking a lot of notes. I'm going to cue you when I think the note is important. You can take as many notes as you want. And I'll go slow to make sure you get that note written down. If you have a question, I want you to raise your hand and ask the question, because we've got so much material to go over. You're not going to remember what that question is 60 minutes from now. You're also going to be entitled, and we're going to email this to you, a retirement rewards kit. This is going to be chock full of articles and information on a lot of the topics that we're talking about tonight, particularly the new tax law that went into effect for 2018. There's also a neat little section in here that gives you some very unknown discounts for airlines, hotel, restaurants, and retail establishments. We've dug out and found out what the how to get a hold of those. These are not published discounts, but you'll be entitled to that, so there'll be some value there. The takeaway tonight, because we're going over so much information, I wanted to kind of organize it. In your packet, you've got a piece of paper that looks like this, and it talks about the 5 tax concepts. So I want everyone to take that piece of paper out because you're going to start making notes on this. These are going to be the 5 concepts that we're going to go over. It's not my intent for you to do your own tax return, but you are going to become familiar with some of the hurdles that we have in the new tax code. So as I mentioned, my name is Stephen Dellelo. I'm president and founder of Retirement Income Strategies. We're a holistic financial planning firm located right here in Easton. There's a bio in your pamphlet that you can read on your own time, but just a couple of things that you should know. Number one, I've been doing this for almost 30 years. I'm a chartered financial consultant. I'm a fiduciary. And yes, I am an accountant. But don't hold that against me, because I'm going to try to make this as light and as humorous as we can. Because who else would come out on a stormy night to listen to a guy talk for 60 minutes about taxes? All right? So I'm going to make sure it's worth your while. So as I mentioned, my office here is in Easton. I also live in Easton. And I live here with my wife, Lorraine. We've got 2 grown children, Jennifer and Matthew. It's a funny thing about the kids. They grow up so quick. I can remember helping them with their high school chemistry exam, pretending I knew what it was about. Next time you blink, you're walking someone down the aisle. And now I blinked again, and believe it or not, Jim, I'm actually a grandfather. I don't look that old, but I've got 4 grandchildren. The oldest is 4 years old, and it's a new job description for me. I don't have any experience at this, so I don't know what the heck I'm doing. So this is Eleanor. She's just turned 4 years old, and she's my daughter's daughter, and they live in Iowa, which is a topic for another seminar. But I called Jennifer up and I said, gee, Jen, what would Eleanor like for her birthday? He said, oh, that's easy, Dad. She wants the My Little Pony figurines. Now, I can tell by the age of the group here, we probably haven't been in a Toys R Us for a long time. I know I haven't. But what you don't know is that in a prior life, I used to work for Hasbro Toy down in Pawtucket, Rhode Island. And I worked for them during the 80s when it was the go-go years. G.I. Joe, Cabbage Patch, and we invented My Little Pony. I know everything about the My Little Pony, the storyline and the fantasy and the colors and all of that. I said, this is going to be a home run for me. This is going to be easy. I'm finally going to get this one right. So, Peter, what do you do when you can't go to the mall? You go to Amazon, right? So we went to Amazon. Sure enough, Janice, they had a packet there, 12 My Little Ponies, 12 of them. I'm a Prime member, get free shipping to Iowa. This is beautiful. So I had them shipped to Iowa, and this is what they look like. Does anyone see a problem with that picture? What the heck happened to my 3.5-inch figurines? These are the 1-inch jobs. So somewhere in the translation, they got messed up. Now, you're probably sitting there and you're saying, okay, that's a cute little story, but what the heck does that got to do with taxes and retirement? The moral of the story is experience counts, and experience matters. Now, I may not have the experience I need to be the grandfather that I want to be, but I've been doing this for almost 30 years, and I love talking about taxes, and I love talking about tax strategy. Now, you might be sitting there saying, well, wait a minute now, we've got a brand new tax code on the table, don't we? And you may feel right now that you've got a void in your knowledge and your experience to handle this new tax code. But after this hour is up, I am going to give you information that you're going to feel more comfortable on how to handle this tax code in your particular situation, because you're going to be armed with actionable knowledge that you'll be able to take with you. So with that, let's get started. So the first thing we want to do is, why are we here tonight? We're here to teach important information that too few people understand and that no one is discussing. We're here to help prepare you for critical decisions you must make very soon, to guide you through a very important process, and to help you if we can. This is the disclosure page that the attorneys make me put on. The disclosure is that I do not work for the IRS. I do not work for Social Security. I don't work for any government agency. I am an independent financial planner. So our goals tonight is to understand the relevant changes to personal income tax and the Tax Cut and Job Acts of 2017. This was a huge, huge tax law change, and it's going to have huge ramifications going down the road. I don't think the press has given it enough attention. We're going to understand the impact of the tax cuts in a retirement income stream, and we're going to identify those tools and strategies available to middle-income retirees. And then we're going to avoid the political and stick with the actionable. Look, we can only work with the cards that we've been given, and right now, this is what the deal is that we have, which is different than it was last year. So this may look familiar. You'll probably could fill yourself into that picture about a month ago when you were doing your taxes. So we've got some good news and bad news. The good news is you won't have to do this ever again because that tax law is gone. The bad news is you are going to do it again because we've got a whole new set of tax laws. Hopefully it will be a little bit more simplified. All right, you have this chart in your folder, and I want you to pull it out because we're going to be referring to this as we go through the presentation. This is an example of the tax code, the new tax code and the old tax code. On the right-hand side, you'll see where the code was last year. Started at 10%, went to 15, 25, et cetera, all the way up. Now it still starts at 10%, and it goes 12, 22, et cetera. The brackets have gotten a little bit wider, and I want you to notice that the tax bracket really starts from $1. That's where the bracket starts. That doesn't necessarily mean how you're going to end up paying your taxes. So this is what's known as a progressive tax system. Unlike what we have here in the Commonwealth of Massachusetts, we have a flat tax. So the way the separated progressive tax works is you're going to pay 10% on all money up to $19,000. That would be $19,005. And then you're going to pay 12% for everything above that number. And then you're going to pay 22% for everything over this number. So it's step rate, it's progressive. The first tax concept that we're going over, it's known as the marginal tax bracket. So this is the first note you want to take down. The marginal tax bracket is the tax rate that you pay on the next dollar, the last dollar coming in. It's not the tax rate that you paid on all of the dollars. That's something else, and we'll get to that at the end of the presentation. So those are your marginal tax brackets. One thing I forgot to mention, and you might want to make a note of this, I'm sure everyone knows that the tax law that was passed is temporary. It's not permanent. So this tax law is only going to last 7 years. Now, there's three things that can happen here. Congress can do nothing, and in 7 years, this tax law will just go away. It's called sunsetting. And what will happen? The 2017 tax laws will come into play, and those are the rates that I just showed you. So everyone's rate will go up. That's if Congress does nothing. The other thing that Congress could do is they could get around making the tax law permanent and make it a permanent part of the code. We don't know if that will happen or not. A third thing that might happen is we're about to, this year, come into a midterm elections. And they're talking about the blue wave that could happen. If the Democrats take control of Congress, they could repeal this law and it could put it back. Now, if you listen to the pundits on TV, they'll tell you, oh, that will never happen, it can't happen. Let me tell you something. If I were a Democrat and I wanted to repeal this law, I could sell this to you like popcorn. All right, this was a ill-advised tax law. We can't afford it. There wasn't enough debate. We got to think of the children. We got $20 trillion in debt, yada, 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 and all of the rest of it. And as a politician, I'm not going to increase your taxes. I'm just going to put them back the way they were. So we should really get rid of this thing. That's how they're going to sell it. The reason I'm bringing this up is that the tax strategies that we're talking about have got some sense of urgency to them. We know we got a 7-year window on the outside, and we could have as little as maybe a year and a half. We don't know. But we can't sit back and say, oh yeah, I'll take care of that later. So there is a sense of urgency. Let's talk about capital gains and qualified dividends. These have their own tax schedule, and they're also progressive. And the reason why the government gives you a different tax schedule is they're trying to redirect how you're investing your money. It's supposed to be for the greater good. So this is what those tax schedules look like. So if you have taxable income, not the gain, taxable income. And what is taxable income? It's the amount of money that shows up on the backside of your tax return, typically line 43 if I don't have my glasses on. But it's the total amount of taxable income. If your taxable income is over $77,000, and it falls just below 500, your capital gains rate is 15%. Now, if you're on a 22% tax bracket, this is a much better deal for you, isn't it? This is why they talk about Mitt Romney never pays any income tax. That's true, he pays capital gains tax. But there's an interesting thing that's on this chart. Notice the zero that we have here. If you have taxable income of less than $77,000, your capital gains rate is 0. You don't pay anything on that. Now, that would be an interesting thing to know when I'm developing different streams of income and how they're going to be added, because that's going to be one objective that we're going to want to try to achieve. Here's another note you want to take. Taxable income does not equal, so put an equal sign with a slash through it, disposable income. The amount of income you need to live in your world is totally separate from the amount of income that you're going to report on your tax return. Here's the second note you want to make. The age that you take Social Security does not equal the age you want to retire. Those are two separate decisions that you'll make, and there's two separate sets of criteria that you're going to use. You don't come to me and say, Steve, I'm going to turn 66 next year, so I'm going to retire. Well, maybe yes, maybe no. We'll see. And the other question is, do you really want to take Social Security at 66? Maybe yes, maybe no. You've got to do the analysis. All right, let's move on. So this is what the tax map looks like, and we're going to be looking at these red little staircases throughout the presentation. This is the normal tax map, and notice again that the tax doesn't kick in until you get down to around $77,000. So that's a big piece of information to know. So let's talk about deductions, exemptions, and credits. These are all things that go on your 1040 to help develop the amount of income tax that you're going to pay. So we're going to talk about deductions first. So the first note you want to take on deductions is you get a deduction for anything you spend money on. So I've spent money on stuff, I'm going to get a deduction. The deduction reduces your income, gross income, to arrive at your taxable income. So let's take a peek at what it is. So in this new tax law, they really made a lot of changes to deductions. So first of all, we know it's the amount deducted from your taxable income. You have what is called a standard deduction of $24,000 if you're married filing jointly. Last year, that number was $12,000. So everybody, right out of the gate, is going to get $24,000 deduction off their income. So statistically, the first $24,000 of your income, there's not going to be any tax at all because you're going to have that deduction. Further, if you think you've spent more money on things than $24,000, the government gives you an opportunity to list that out. And they do that on what? On your Schedule A. And you remember how Schedule A works. You get your medical, your taxes, and your real estate, all the rest of it. Well, they've made some modifications. First one is mortgage interest debt that's taxable only up to $750,000. Last year, it was $1 million. So if your mortgage is greater than $750,000, you're not going to be able to deduct the interest on that portion that's over $750,000. But that's not the big news. The big news is it does not include the HELOC. That's a home equity line of credit. You know the strategy we used to do? We're going to buy that car, right? You're going to buy the car, I'm going to buy it on my home equity line because my interest is what? Deductible. Not anymore. So that went out the window. So we don't have that. Charitable deductions went up, and this is the big one, the SALT deduction, the state and local tax. This may or may not hurt you. It depends on where you live. The maximum deduction for real estate taxes, et cetera, is $10,000. So if your real estate taxes are under $10,000, it's not a point. But if your real estate taxes were $16,000, $18,000 a year, you lost out. You do get a deduction for being over 65 or blind. Exemptions. Exemptions you get for not spending money for just being alive. So if you're breathing, you get an exemption. The dollar amount you get for the exemption is exactly the same no matter what age you are. So my granddaughter Eleanor gets an amount, and my mother, who's 95, gets the same amount. It's not discriminatory. The problem is this went away. So we don't have those exemptions anymore. They're $4,050. Now, there are some exemptions for people over 65, but the $4,000 piece went away. Credits. Credits are used to kind of drive certain behavior. Here's a list of some of the credits. A credit is a reduction of the tax that you owe. It has nothing to do with the income that you made. So if you know that the credit is a reduction of the tax you owe, that becomes very valuable, doesn't it? It's the most valuable thing that we have to work with on our tax return. One of the most popular credits is the solar credit. People with solar panels on their home, you get a nice big federal tax credit. So let's put them all together. Here we have a married couple filing jointly. The combined income was $38,000. Right out of the box, they get a $24,000 standard deduction. They're over 65, so they're going to get $1,250 each as an exemption. That totals to $26,500. They made a $2,000 deduction to their IRA. Remember, your IRA deductions go on the front page of your 1040 down on the bottom here, so it's a reduction of the gross income. So when you add these numbers up, their income subject to taxation is $9,500. If we go to the chart, you'll find that that falls right underneath the $19,000 mark. So they're in a 10% tax bracket. 10% is $950. But wait a minute, they get a credit because they put money into an IRA. So there's the $1,000 credit, and it virtually wiped out the tax that they had. So their tax map, if I take this information and I create it like I'm going to for you, their tax map looks like this. Pretty normal. Notice that the tax didn't kick in at $19,000 and went all the way out to just under $30,000. That was because of the deductions. So the deductions, you were able to push off that staircase, if you will, before it kicked in. Now, if preparing taxes were that easy, we wouldn't be here tonight. So we know it's a lot more complicated. In the real world, the real tax system, we've got all of these things that are going on. Required minimum distributions, capital gains, Social Security benefits, etc. And we're going to review each one of these. Now, this is how I want you to think about this. Think of this tax return as the face of a clock. Behind this tax return, there's a bunch of gears. These items represent the gears. And once one of those gears gets into motion or is activated, it could touch another gear, which would then touch something else, which would touch something else, and all this stuff starts cascading. Nobody pays attention to this stuff. You just accept what's given to you. You have more control over that 1040 than you think, especially in retirement. And the taxes work differently in retirement. It didn't really matter while you were in the accumulation stage and you were putting money away. But now it does, because you're not putting any money away, right? When you're retired, the capital stack, that's it. And that capital stack's got to last us another 25, 30 years. We'll get into that later. So let's talk about these individually. You'll see these on your sheet. The first one is the required minimum distribution. I'm going to spend a little bit of time on this. If you don't know already, if you have a retirement account, you can defer that money as long as you want until you turn 70 and a half. And in 70 and a half, the IRS is going to mandate that you take out a required minimum distribution. Now, you could be taking money out ahead of time. In fact, does anyone know when's the earliest you can take money out of an IRA? What age? 59 and a half, that's right. Very good. So at 59 and a half, you can start taking money out without a penalty. But at 70 and a half, the government's going to say the gig is up and you're going to have to start taking money out. So in this case, we have a taxpayer that's got a $500,000 balance in an IRA. And by the way, I am going to use the word or the term IRA as an all-inclusive. And when I say that, I mean your 401k, your 403b, your 457, all of the retirement accounts, all right? So we have a retirement account of $500,000. This person's 70 and a half, and they're going to have to take $18,000 out in that year. That's the factor. Don't write this down, but the actual rule is the latest that you can wait to take money out of an IRA is April 1st in the year following the year you turn 70 and a half. The problem with that rule is if you wait to that year, you're going to have to take 2 distributions out. So for this fellow, it's going to be $18,000 for the first one and probably another number that is bigger. I guarantee you it's bigger than the $18,000. It could be another $19,000, $20,000, and he has to take them out in the same year. What's that going to do to his tax return? He could have what we accountants call bracket creep. You know, push him up into another bracket, go from 12 to 22, et cetera, all the way up. So here's the Steve Dellelo rule, and you can write this one down. When you turn 70, you stop pulling money out of the IRA, if you haven't already, all right? It doesn't make any sense to wait, all right? Because you got to ask yourself, how did we get here? How did we get to this point? I'm going to roll the camera back about 30 years, 40 years. You got out of college, you got your first job, you worked in that job for a little while, and then after about 6 months or a year, you went down to what they call the personnel office. Today, you call it human resources. And you signed up for what? What'd you sign up for after a year of employment? The 401k, right? All your employees had the 401k, so you signed up for it. So Ed over here, he signs up for the 401k, and he asks the lady or the gentleman, well, how is this going to work? He says, Ed, it's a terrific deal. You're going to put pre-tax dollars into this account. And you won't have to pay any taxes on it. And it gets better than that. The money that's in there continues to grow tax deferred, and you won't have to pay any taxes on that. So Ed says, well, wait a minute, when do I pay the taxes? And they say, well, when you take the money out, of course. So Ed says, well, how is that any kind of a deal? Why don't I just pay the taxes right now? No, 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 Ed, you don't understand. Now, what did they tell you? When you retire, you will be what? In a lower tax bracket. And why will you be in a lower tax bracket? Because you're retired and you don't need as much money. All right, let's examine this mantra that was fed to us, okay? Even we accountants were trained incorrectly. We were trained to use the 70% rule. You take the last 3 years average of your employment and take 70% of that, and that's what your retirement income is going to be. Says who? When you retired on a Friday, you used to get a gold watch and maybe a pension. Then they switch it, you get a set of golf clubs. You don't even get that anymore. You're lucky if you can get a Papa Gino's pizza and you're on your way. Monday morning, you wake up, you're retired. Someone explained to me what happened over the weekend that allows you to live off of less money than you had 2 weeks before. This just doesn't make sense. I've been doing this for almost 30 years, and I can tell you that no one has come into my office with this kind of story. We'll call him Jake, okay? Jake comes into my office and he says, you know, Steve, Helen and I, we have taxable income of $150,000. I'm going to retire. We sold the house. We're going to buy a trailer and live down by the river, and we're going to live off $100,000. Good for you, Jake. You took a 1/3 cut in pay. Now, I'm not saying you can't do it, but it sounds a little unusual. I want you to look at your chart. Tell me what tax bracket Jake was in before he retired at $150,000. What was the number? 22%, right? Okay. Now, he just cut his income by 1/3. What's his tax bracket at $100,000? 22%. Oh my gosh, isn't that, what a miracle. The tax bracket, it's almost impossible to get in a lower tax bracket. All right, so we've got two things working here. Nobody takes a pay cut when they go into retirement. I've had knockout, drag-out fights with doctors that make $400,000 or $500,000 and they're going to retire, and they demand that their portfolio has a 100% replacement ratio. And I says, you're on drugs. What do you need $400,000, $500,000? But you know what? They do. You know why? Because that's the world they live in. They're accustomed to that. The boat, the country club, whatever it happens to be. They really need that. So you're not going to retire on a lower amount, and your tax bracket's not going to go down. Which begs the question, should you put money into a retirement account now? So what's going to happen to this individual is every year he's going to have to take out the required minimum distribution. This is what the chart looks like. And you'll notice that the divisor goes down every single year. So if that $500,000 never earns another dime, his required minimum distribution is going to continue to go up. Now, people are saying, well, gee, Steve, what's the matter with that? I've got that retirement account. I've got to take that money anyways. We're going to see in a minute that this is one of the gears. What if you don't need to take that full amount out of your retirement account? You've got your act pretty well organized. You've got your expenses, but you don't need all that. That means you're going to be paying taxes on income you don't want and you don't need. So what I'm here to tell you is all of us ended up doing the same thing. We all put the money into the retirement account thinking that that mantra was going to come true. We know that it's not come true. So these accounts now are tax infested, and they've got to be adjusted or corrected. One of the ways to do them is to think about the conversion to a Roth. Now, I'm going to give you two strategies right now, two different things that have happened, and then we can wrap this part up. So someone may want to retire at age 66. And at age 66, they say, I'm going to retire at age 66 because for everybody in this room, that's going to be your full retirement age for Social Security. That means that I'm going to get 100% of my Social Security, and I can work as much as I want, make as much money as I want, and I won't have a reduction in Social Security. So you take your Social Security at age 66, and what generally happens is, well, I'm going to work, I get Social Security coming in, I'm okay. I don't need to take money out of the IRA. I'm going to let that baby just ride because after all, I don't have to pay taxes on it until later on. So I'm going to let it go and I'm going to let it ride. So here's what goes on. For the next 4 years, you're going along happy as a clam, and then all of a sudden you've gotten, growth in your IRA, and now you've got this required minimum distribution that's going to come down, and it lays on top of your tax return. We're going to see in a minute that Social Security that you were receiving that was probably tax-free is now going to be taxable. Here's a different strategy. Let's say you're going to retire at age 66, and instead of taking Social Security, you're going to delay it. But wait a minute, Steve, I need that money. Use your IRA. Take the IRA down, the distributions for 4 years, and then when you're age 70, you have to take your Social Security. If you don't, they're going to send you the check anyways because they know about you. How do they know that, by the way? If you didn't go to Social Security, file for Social Security, take your check, when you're 70, you're going to get that little green check in the mail. How do they know that?
You're paying into the system all along.
Because what?
You're paying into the system all along.
Yeah, but they don't. But the IRS doesn't communicate with the Social Security system. What?
Is it Medicare?
That's right. At 65, you signed up, so they know you're out there, and they're waiting for you to come in. They're waiting for you to tell them what to do. So if you don't tell them what to do, at 70, the check's going to come. If you don't take the Social Security at age 66 and instead you took the IRA amount of money, the Social Security you take at age 70 is going to be 132% greater. Now, didn't Social Security just pay you back some of the money that you just took out of the IRA? Because your payment is a third greater than it would have 4 years earlier. That's just one general strategy. Further, you've detoxified that IRA. You've brought it down, so when the RMD hits, it's not as big. All right? So it's just a strategy. Might work, might not. So sequence of return. Sequence of returns are the returns that we're getting in the market over an extended period of time, and they're random. We never know what they are. You have a piece in your packet that you want to pull out, and I want to make sure you have the right one. It says before retirement. This looks like a confusing slide, but I'm going to walk you through it step by step. It's actually pretty straightforward. This is called the sequence of return risk. Well, first of all, let's just define it. So sequencing of returns may have less of an impact on the portfolio of a long-term investor who is no longer putting money in or taking money out. So if you just got a portfolio just sitting there, inactive, you're not putting anything in, you're not taking anything out, you're probably going to be okay. But the relationship between an investor's rate of withdrawal and the sequence of returns can have a dramatic, notice they put that in bold, dramatic impact on your portfolio's ability to last through the withdrawal period, usually retirement. And that withdrawal period, pick your own number, is going to be somewhere 20, 35 years. That's how long this has got to last. So what we did is we put two portfolios together. We have portfolio A and portfolio B. And we took 24 years of S&P 500 returns. And I want you to notice that in portfolio A, the first 3 years, we have negative returns. In portfolio B, what I did is I took these returns and I just flipped them so I could get some randomness. These negative 3 years returns are down on the bottom. These positive 3-year returns are at the top. All we did is we just flipped them. We're not taking any withdrawals out. We're going to start with $100,000 on each, and we're going to get an average rate of return of 8%. That 8% is just the average, the arithmetic average of the numbers that are on the sheet. When I looked at this earlier today, I couldn't find an 8%. I think there's one. Yeah, right here. So that tells you something about averages, right? But we're going to grow this at an average rate of 8%. So the question is, what's the value at age 65? In portfolio A, it's $684,000, and lo and behold, portfolio B, it's $684,000. Now, this has got nothing to do with tax strategies, and it's got nothing to do with financial planning. It's just dumb math. That's the way it works out. You get a sequence of returns, and if you're not taking anything out, it doesn't matter how those sequence of returns work, the number will always end up being the same. Well, let's change it up a little bit. We're going to go to the next slide, and you'll have that one in your packet, and that one's going to say after retirement. We're going to change something here. We're going to keep the returns exactly the same, but we're going to take a withdrawal of 5% in the first year, and we're going to adjust it for inflation. We're going to start with the numbers that we accumulated at age 65, 684,000. Again, the rates of return are an average of 8%. How much money do we have at age 90? Well, in Portfolio A, we ran out of money at age 81. In Portfolio B, we ended up with 2.6 million. What's the difference? It's just luck. So you have to determine, are you going to be lucky or you're not going to be lucky? Now, what is something that's going to cause you to take money out of a portfolio when you don't have any control? We just talked about it, a required minimum distribution. So if you have a required minimum distribution and it's a large one like the one we just saw, the 18,000, it's going to cause you to take money out of that portfolio, and it might be a good year and it might not, but you've got to take that money out. So we want to be careful about sequencing return risk and make sure that we can, you want to control the withdrawals out of your account. You don't want to be, you don't want it to be dictated to you. So let's talk about capital gains for a moment. You'll have a taxable account. It's outside of the retirement account. You could have some capital gains from mutual funds. This happens all the time. The mutual fund manager needs to do a redemption. Maybe he wants to take some money off the table, or maybe, like what happened at the end of January, beginning of February, everyone got a little bit nervous in the market and they started calling their broker and they started redeeming. That correction that we had at the very end of January, that was created by retail. There was not a professional money manager sitting at the desk saying, let me see, yeah, we've had this run up, it's about time we started taking money off. No, that's not what happened. It was all the retail customers that wanted to get off the bus that got nervous. When that happened, the margin calls kicked in, and then all of the computer programming selling happened, and that's why we had that dip. The second dip that we had about 2-3 weeks later, that was a real one that was manufactured by some what we call systematic risk, things that happened in the international global market. So you're going to get capital gains, and I like it when people come in the office, they show me the tax return, I go to, I think it's line 9, whatever, and I say, geez, I noticed you got a capital gain of $10,000. Did you go on a cruise or something, or in addition to the house? I didn't get any $10,000. Well, it's right here. You're paying taxes on it. It's phantom income. You didn't get the money. Where'd the money go? It went back into your mutual fund. Rebalancing could trigger capital gains. And then this is my favorite. Long-term capital gains can create ordinary income. Wow, how can that happen? Well, let me give you an example. So here we are, we've had a pretty good run up in the market, and it's now January, and you feel more comfortable now with mutual fund XYZ. So you decide you're going to put money into mutual fund XYZ because it's been growing like crazy. Well, the manager for XYZ in around August, September thinks that there's too much risk going on in the mutual fund. So in the interest of the shareholders, he's going to sell some of the gains, take some of the money off the table, and just buy other securities. Okay, so he created a capital gain. But unfortunately for you, you bought that mutual fund in when? January. You didn't own it for 1 year. So that capital gain is going to come down to you on a 1099 as ordinary income. So instead of paying the 15% that you could have paid, you're going to now pay whatever your marginal bracket is. And we'll just assume for a second in the group it's 22%. All right? So that can actually happen. All right, so this is a note that I want you to take. This is a concept called provisional income. And people will come into the office and they'll say, gee, Steve, I'm filing for Social Security. Gee, Jan, is my Social Security going to be taxable or not? Well, it depends. This is how we're going to determine it. There is a formula that the IRS uses called provisional income. And when you go through that formula, if your income reaches certain thresholds, then it's going to pull in the Social Security. Let's go over it. So the first thing that's going to be counted, in provisional income is 50% of your Social Security gets called in. So think of it as of a platter. 50% of the Social Security that we receive, boom, is on the platter. What else? Ordinary income. What could be classified as ordinary income, do you think? Anyone? The RMD, right? Sure, the RMD. That if you retired at 66 and you didn't take any money out of your retirement account, that's a big number at age 70, and that could be a surprise. So the RMD is there. What else? Your dividends and capital gains. Capital gains that you probably never received because they were phantom income. But maybe you did. But there it's all counted. You got to throw it on there. And then this is my favorite, the non-taxable interest from municipal bonds. So that municipal bond that you bought from your broker, and he says, oh, this is tax-free. Yeah, the income is tax-free, or what we accountants call the yield. The basis or the principle, you bought the bond for X and you sold it for X plus, you're gonna have a capital gain on that. But it doesn't matter. The income that you received on that you did not pay income taxes on, gets counted in this formula. So we add them all up together, and these are the brackets. So this is the amount for a single person, this is the amount for a married person. If that number in that formula reaches $32,000 and it goes back to $1 and 50% of your Social Security will be included on line 20 on your tax return. If it goes over $44,000, then 85% of your Social Security is going to be added. Now, start to think about the gears that we talked about. What would happen if your Social Security gets pulled into your tax return because 85% of it was taxable? And what if you had a capital gain? Oh, I don't know, $8,000, $9,000, $12,000. And on top of that, worse yet, what if you had an RMD? That could put you over the $77,000 piece, right? Which now means that the capital gain is getting pulled in. And we're going to go over an example on that. But I hope you can start to see how all of these gears are intermeshed. And if you touch one, it could touch another, which will touch another. Oop. So let's go over an example. We're going to have two scenarios here. The first one, the person took $20,000 out of the Social Security, $40,000 out of the IRA. The provisional income is $50,000, right? You got to count all your income plus half of the Social Security, 10 and 4 is $50,000. So now we got to run through the math. $50,000 minus the first threshold. This is a married person filing jointly. The first threshold is $32,000. How much of that is exposed to tax? $18,000, 50%, $9,000. Just work with me on the numbers here for a second. So then we take $50,000 and we subtract the second threshold. You're $6,000 over that threshold. Take that threshold times 35%. Why? Because I already took care of the other 50, didn't I? 50%. So that gets me to the 85. That's $2,100. $2,100 and the 9,000, that's $11,100. That is includable in your taxable income, or 55% of your Social Security, which may have been tax-free earlier. But because you had all of these component pieces inside the provisional income calculation, it sucked in that Social Security. Let's look at the second example. The second example, what I did is I just switched the numbers around. This person took Social Security, $40,000, and now they got a $20,000 IRA. What might you assume from the data that's on the chart here? This person's got a $20,000 Social Security payment. This one's got a $40,000 Social Security payment. The first person did what with their Social Security? They took it
younger.
Early, that's right, very good. The second person took it later, maybe at 70 or whatever. And by the way, there's no right or wrong answer to Social Security. We have special software in our office that will calculate, do all the calculus for you to determine, is it worth it for me to wait to age 70 or should I take it now? And you'd be surprised. I always try to beat the computer and I never can. A lot of times it does not come out to age 70. A lot of times it comes out to age 68 in 3 months, age 69 in 2 months, because it does all the calculation, and this is what it says. Is it worth it for me to take the money now and have it in my possession, or is it worth it for me to delay and get the 8% increase? And it does that. So it's pretty fascinating. So anyways, we we come out with the $40,000 minus the 32, that's $8,000 is exposed at the first level. So $4,000 is going to be included in the taxable income. What about the second threshold? They never hit it because the taxable income was only $40,000. I mean, the provisional income was only $40,000, right? So they were under the $44,000. So it didn't kick in. So these people, it's only 10% of the Social Security is includable in their tax return. A little less burden, a little lighter, a little easier to go, all right? So let's see how this looks like on the tax return. So the first, folks, we got $11,000 of Social Security get dragged in. We got other income, $40,000 from the IRA. That gives me total taxable income of $51,000 minus the standard deduction. Now remember, they're over 65, so they're going to get their exemption for being over 65. And net taxable income is $24,000. Looking at your chart, what's their marginal tax bracket? Be 12%, right? 12%. So the tax will be $2,571. Now we already know what the second person is going to make out. You put their numbers together and they don't have any federal tax. The question you got to ask yourself is, which tax return do you want to sign? All right, Medicare, Part B, Part D. When you were 65, you signed up for Part A. We know that's free. But Part B, you have to pay for, and Part D, you have to pay for. What you need to know is that those are means tested. So the more income you make, the higher the premium. Those are where the rates are. They check that every 2 years on your tax return. And there's another reason why you might want to manufacture or take management of your tax return, because it does affect your Part B and Part D premium. And not a whole lot you can do about that because these are the numbers. There's another tax we have to be careful of, and it's the net investment income tax, otherwise known as the Obama tax. This is what was tagged on during the Obama administration to help pay for Obamacare. If your adjusted gross income is over these thresholds, if you're married, then you will be subject to a 3.8% extra tax in these particular categories. Now, to be clear, what's the adjusted gross income? It's the number on the bottom of the front of the page. It's before you get to your deductions, before the deductions, the gross income. So you can kind of get a feel for how does Congress affect the tax rates and the amount of revenue they pick up. They don't fool around too much with the tax rates. What they do is they limit and they fiddle with the deductions and the exemptions and the thresholds of when things kick in, because that's less visible to us, you see. Okay, effective marginal rates. This is a note I want you to take. Effective marginal rate, just kind of think of that as the average tax rate that you're going to pay on everything after it gets all homogenized. This is the traditional tax map, what we call the ordinary income tax map. And during the second part of the workshop, I'm going to create your individual tax map so you see exactly what yours looks like. We're going to see an example of that in just a second. This is the tax map for the capital gains tax. Not very exciting. The key thing here is it doesn't really kick in until 77,000, then it shoots up to 15, and then it's a flat, kind of a flat tax until you get to just before 500,000. Don't forget, the capital gains tax does not trip in on the amount of the capital gain. It trips in on the total taxable income. So they're adding everything together, right? That's 70,000, 77. Okay, so let's go through a case study on the real tax system, and we'll see how these gears all kind of intermesh. So we've got John and Jane. They're filing jointly, and they're over 65. They've got a combined Social Security of $60,000, which would not be unusual if someone's got their full 40 quarters in. They have a $15,000 long-term capital gain from their taxable account. And they have a $45,000 required minimum distribution. So this tells me that they're over the age of 70 and a half. So we put this all together, and we look at the tax map, and we can see the gray is what their tax form looked like. This is the traditional ordinary tax. Notice it didn't kick in at 10%. It didn't kick in at 12%. It kicked in right away at 18% for a certain amount of money. Then it jumped up to 22% before we even got to the 10%. And then there was a spike here of a certain amount of money that was paid. 49.9% was their marginal rate on a certain piece of money. Now, how in the heck can that happen? I just gave you the chart, and the chart says the top end tax bracket is 37%. But this is what the effective rate is going to be. So how did that happen? You would have thought that intuitively, for every $1,000 that John and Jane took out of their IRA, they were in that 12% tax bracket, right? So they would have paid the $120 on every $1,000 piece that's coming of income. So that's what we're going to examine, each $1,000 piece. But this is what actually happened. They took the $1,000 IRA distribution and they paid the 12% on that piece. But that distribution caused the Social Security to be pulled in at the 85% level. So there was another $850 that was going to be taxed, and that was taxed at 12%. So now we're up to 102. We added 102. When those two gears kicked in, it caused that capital gains to be pulled in because they went over what? They went over the $77,000 limit. So it got pulled in. And it got pulled in not at 12%, at 15%. It would have been wonderful if they could have kept that capital gain and paid zero. But this is how the math worked out. So you add it up all together, for every $1,000, they paid $499. Now, they didn't pay that 49.9% on the entire amount because, fortunately, Social Security is going to run out. It was only 85% of the bucket of the amount of money that they pulled in. And this is what the capital gains looked like. The capital gains spiked because of all of the other gears that were in play. So, the tools for tax control. The ideal scenario would be to have a lot of diversified buckets. Most people do not. Why? Because we took all of our money and we put it into a retirement account. And that's where it sits today. But if we could diversify money into the out of the IRA, and you have an opportunity now to do a Roth conversion. You can take money in that IRA, and as long as you're over 59 and a half, very slowly, you can take a piece of money and move it into the Roth over time. And the way you would do this is, take my example of Jake. He had $150,000 of taxable income. When he retired, he was only going to take $100,000. What's the top end tax bracket that he was in at the 22% bracket? The top end was what? 165. So he's at 100. This is the mistake that all accountants make. There's $65,000 in that tax, well, as you look at it, $65,000 in that tax bracket that he's wasting. And if he doesn't take advantage of it, it's gone, because we pay taxes once a year. Does everyone kind of get that? Because if I leave that money in the IRA, and if it goes beyond 7 years, I'm probably going to pay a higher tax. So what you want to do is you want to maximize your bracket. It's called bracket efficiency. But wait a minute, Steve, I'm going to end up paying more taxes. Yeah, that's right. But you're not going to pay any more taxes than you would have anyways. The tax burden is already in the IRA. That $500,000 account that we were talking about, just so I can do the math in my head, if that guy was in a 20% tax bracket, how much money does he have for lifestyle? He's only got $400,000. That extra $100,000 doesn't belong to him. That's a lien. He owes the IRS that amount of money. Now, he's got a choice. He can pay that money now, or he can pay it later, but it's always going to be $100,000. It doesn't matter. It matters now, since we're in a lower tax bracket. I was in my office before I came over here, and this was totally unrehearsed. What do you think I find on my desk is Financial Advisor magazine and an article in here that says, trimming taxes with a dynamic Roth conversion. The author says, and I quote, "Generally speaking, advisors and academic researchers say that this might be the good time for holders of tax-deferred IRA accounts to convert them to Roth IRAs, now that the recent congressional legislation has lower taxes." So you can take your choice. You can convert now or you can convert later. Now let's not confuse conversion with making a contribution. Most of you in here make too much money to make a contribution to a Roth anyways, unless you're going to do it as part of your 401k. But a conversion from a retirement account, you can do that all day long. The IRS will let you do that because you've got to pay the taxes going in. But wouldn't it be wonderful if you could transfer that money into the Roth and let that Roth sit there and percolate and build back up and maybe pay some of that tax back to you, because it's all going to be tax-free in the end. So that's just one general technique. Use deferred products where appropriate. Other than now there's no such thing as an IRA investment. There's no such thing as a 401k investment. Those are just places. The things you put inside the IRA could be stocks, bonds, mutual funds, ETFs, even annuities. And someone will say, well, gee, why would I put an annuity inside a qualified account, a retirement account? Because the annuity is going to give you a guarantee that you can't get in the regular market. It's like getting another Social Security check or another pension check. So that may or may not be relevant. You want to properly blend the withdrawals from different accounts. If I need X amount of money to retire, and I know my Social Security is coming in, and I'm going to have a capital gain, I don't want to pay taxes on it, and I have a Roth over here that I can take money out tax-free, but I need that to make my commitment for lifestyle, I can blend those together to stay under the thresholds, and maybe even my Social Security will be tax-free. The example we saw earlier with John and Jane, they had no control. That money was just coming in. It was just what I call mailbox money. They couldn't control it, and that was the result. What else do we have? Consider which assets should be held in which accounts. When you think about it, the IRA is a terribly inefficient account. I'm going to give you an example. I've got a client right now. He has 200 shares of Apple Computer in his IRA. I just checked it today. Apple's closed at 186. That's a big number. His cost basis, the amount that he paid for that, was $65 a share. He bought it way long time ago. So he's got a huge capital gain in there. Fortunately for him, if it was in a taxable account, the capital gain would only be at what? 15%. But no, it's not. It's in an IRA. So when he takes that money out, when he sells that Apple stock, he's going to have to pay income tax on it. The textbook, I don't particularly agree with this, the textbook would tell you not to put highly appreciated assets in a retirement account, only put income assets and gems, precious metals, and collectibles. Now, I might agree with the collectibles, because this is a little piece of information that you can bring home. You can look wicked smart. There's another capital gains rate that we never talked about because it hardly ever comes up, and that's the capital gains rate on a collectible. If I sell something that's a collectible, antique car, a painting, some coins, gold, the capital gains rate is 28%, and that's a flat rate. There is no step-rated thing. So a lot of times people will put those in an IRA. I had a doctor one time who he collected meteorites, and he wanted me to put the meteorites in his IRA. The problem is what? Valuation. How the hell do we evaluate that when it becomes to be 70 and a half? Who's to say what the value is? So these are the four buckets that typically you want to eventually end up with at the end of the day. You want to have a taxable bucket so you can take advantage of tax management within your account. You have your tax deferred account. I'm not saying don't have an IRA. What I'm saying, don't have 100% of your money in the IRA. You've got a tax-free bucket, which is going to be your Roth. And by the way, we didn't get to this. What's the other instrument in this country that you can put money in and take money out tax-free, legitimately, so it doesn't end up on your tax return. Does anyone know what it is? What is it? No. No. Is it- No. It's life insurance. If you have cash value in your life insurance, you can take that as a distribution, and if you do it the right way, it's totally tax-free. The life insurance can end up being a depository to move monies from an IRA to a Roth type of setup. So when I'm talking about detoxifying an IRA, there's only two things you can do. You can spend it or you can move it. Just because you move the money out of the IRA doesn't mean you're going to spend it. Put it somewhere else so that it can grow and rehabilitate. Roth and life insurance are the two ways. And just a quick comment on the life insurance. People would say to me, well, gee, Steve, I'm 64 years old. What do I need life insurance for? My kids are growing up. My mortgage is practically paid off. You need life insurance when you're in your 60s and 70s more than when you needed it when you're in 40s and 50s. I'm going to tell you why. You can take this note down. This is what happens to a widow when the husband dies. Three things. Two of them are absolutes. The first thing is her income goes down. Can anyone tell me why? She loses the Social Security. You're getting two Social Security checks that are coming in every month. She loses the lower one. So the good news is she's probably going to bump up to her husband's Social Security. The bad news is that's going to go away. That could be about 25% of their income. In the example we had, it was about 50%. Second thing that happens is your taxes are going to go up. Because why? You're filing single. You're not married anymore. So now you get that dreaded single taxpayer schedule to deal with. And the third thing that will happen to a widow, this isn't absolute, but sometimes it will happen. The amount of money you need to live is more expensive. Does anyone know why? It's more expensive for a widow to live than it is when she was married. Anyone have an idea? Really? No one's not going to like, huh?
Well, what I'd say is if your car payment is one car payment and you're spreading it over two people.
Well, let's hope that you don't have the car payment by then.
Yeah.
The old man's doing the dirt nap. He's not around for the free labor. So everything that she's got to do, she's got to whip out the checkbook. That's why.
The dirt nap.
All right? She lost the free labor. We did this exact seminar this morning. The woman came up to me afterwards. She says, you know, that works sometimes the opposite. When I die, it's going to cost my husband a lot of money because he can't do anything. So that's what will happen. So those are the buckets. That last bucket is a bucket for legacy planning, for estate planning. So it's really basically these three. So at the end of the day, you want to end up this way. Now, let me say this. I had a fellow this morning that came up to me, and we were talking about the RMDs. If you're sitting there and you're 70 or about to be 70, and you're taking an RMD, and you think, oh, gee, does this really apply to me? Yeah, it does. The 70 and a half is just a point in time. The distributions are going to last over your lifetime. The name of the game is to reduce the amount of taxes that you're going to pay over your lifetime. Just like when we do Social Security planning, the name of the game is to extract as much money out of the system as possible, not the highest benefit you're going to get on that particular day. You go into Social Security and you file your Social Security payment, they're going to give you the best benefit that you can get that day, because that's what they're supposed to do. That's what they're charged with. They can't do any forward-looking statements or anything. Yes, Kathy.
I had a question on the Social Security. You had said that you could continue to work and make as much money.
Mm-hmm.
It wouldn't affect Social Security if you took it at full age. And yet,
Yeah.
when you did the distribution and showed ordinary income and how it would affect
Right.
Social Security, so I'm just confused on the two.
Okay, so let me just, depending on your birthday, there's a time when you arrive at what is called your full retirement age. For most of the people in this room, that's going to be age 66. There's a couple of important things about age 66. Number one, that's when you're going to get 100% of your benefit. And number two, there's no limitation on the amount of money that you can earn at 66. You're not going to have a reduction on your Social Security. Because if you take your Social Security prior to your full retirement age, you're going to be subject to the earnings test. And if you go over a certain amount, that's why you'll hear seniors say, oh, it's not worth it for me to work because they're going to reduce my Social Security. Well, sometimes that's true. Did I answer your question?
So is that income, because I own a small business,
Yeah.
and, you know, the income continues. I'm not there yet, but
Mhm.
it will be.
Mm-hmm.
And so if the business continues to produce an income,
Mm-hmm.
you know, and I collect Social Security at full age,
You'll be okay. You'll be fine. You won't be, as long as you're over your full retirement age, and we'll say at 60, you won't have a reduction. But here's what's going to happen. You've got that new piece of income that's coming in on your tax return, and that's what you need to manage. Because the business income is going to get counted in that provisional income calculation, and it could cause your Social Security to be taxable. Most people who have pensions, the good news, thank God you got a pension, you're blessed, because they don't exist anymore. The bad news is almost always the Social Security is going to be taxed. Now, if you're a teacher, you don't get the Social Security, but your husband or your spouse would get the Social Security, and it would be taxed. Okay, so here's the conclusion is that your personal tax map varies greatly based on your personal circumstances. The second part of the workshop, we will create for you your own individual tax map, and we'll have the tax schedules in it. And this tax map is going to do two things. Number one, it's going to verify what your marginal rate is. And number two, it's going to tell me what my effective rate is. Now, why do I want to know that? Because if I'm going to take money out of an account that's going to be taxable, I don't want to be over withheld and take more money out than I need. The next thing that I'm going to do for you is I'm going to take your tax return and I'm going to project it out to age 70, or if you already are age 70, I'll project it out to X amount of years, and we'll get it to see what that tax liability and what that tax return looks like. That will let us bring the management window forward and give us an opportunity to manage that tax return today and make changes and or strategies that will affect the tax return. So that's what will happen on the second part. So this concludes the general portion. Each attendee, like I said, you'll have a no obligation tax clarity analysis, which I just showed you. You simply need to schedule the appointment in the next couple of weeks, and if you wish to decline, just let us know. So what's going to happen at the tax appointment? What's going to happen is that we're going to take the information that you heard today, and we're going to make it more personal. And we're going to see how does it apply or not apply in your particular situation. How long will it take? It will take about an hour. What should you bring? You need to bring your latest tax return and or any other documents you'd like me to look at, and I'll just give you a commentary on them. Will I try to sell you anything? Absolutely not. Unless you're looking for an electric stove, I got one that I'm trying to get rid of. So all you got to do is pick it up. How will I feel when it's over? You're going to feel empowered because you're going to understand what the parameters are of your retirement income plan, and you're going to know the good and the bad, what you need to do, what you can just leave on automatic pilot as part of a plan. Where will we do it? We'll do it at our office. And what will the next steps be? The next steps is it's going to give you a chance to talk. You've heard me talk now for a little bit more than an hour. Now I'm going to listen to what you have to say. Understand what your worries are, what your concerns are, what keeps you up at night. You're going to learn some new ideas as they apply to your situation. I gave you a whole bunch of strategies. Some of them may apply, some of them may not. But they were just rough ideas at the 30,000-foot level. You get to meet our team. You'll get something of value, and hopefully you'll have an experience like you haven't had before. There are three possibilities that are going to happen from this appointment. The first one is that we decide that we want to work together, and we begin to discuss specific ideas and strategies. The second thing is we decide that we would like to work with each other, but the time is not right, and we'll set a date for follow-up. Or the third thing is we decide we don't like each other, we call each other's names, and you'll run screaming out of the room. Okay. Now, you're not sure about scheduling the appointment. Don't worry. We always change the appointment. I know you want to think about everything you've heard tonight, but these are critical issues that could affect your family's entire financial future. The problem is you won't remember anything by tomorrow morning. If you came to my morning session at 11 o'clock, you're not going to remember it after lunch. All right, we went through an awful lot of detail. And yet, I don't know how much of it you retained. I can tell by the lizard looks that I'm getting that your heads are about ready to explode. But that was the idea. All right, the appointment is your chance to reinforce what you just learned here. Pick and choose those things that we talked about that apply to your particular situation. If you have a current advisor, you're here tonight for a reason, whether you know it consciously or not. You're here because somewhere deep inside you sense that you should be doing something better with your money. I'm not saying that you're unhappy with your current advisor. I'm sure they're a nice person. You may, however, be looking for a higher level of care, guidance, intelligence, and protection. You also have a doctor, but your MD wouldn't perform a hip replacement or a heart bypass operation. I'm a specialist in protecting assets for retirement. That's what we do at our firm, hence the name, Retirement Income Strategies. We prepare people for retirement so that you can arrive at retirement on time and fully funded. And taxes is a major part of that. That's what, if what you're getting from your current advisor is what we've talked about tonight, then you're okay. If not, then you should see the difference that a specialist can make. So I'd like to just close with this quote. This is from a federal judge. He says, anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which best pay the Treasury. There's not even a patriotic duty to increase one's taxes. We all want to pay our taxes, but we want to pay the fair share. That's why they call it the code. 75,000 pages, and you got to pick out of that what works for you. So Cheryl is going to pass out some evaluation forms. I hope you take a moment to fill those out, and I hope to all see you for the second appointment so we can make this come alive in your particular situation. And we'll be here for a little while if you have any questions. Thank you.